Eric Muathe with Muathe.com. Let's take a look at this concept that I call the 50 RSI action. All right, so RSI 50, what goes around this level and how we can use this to try and understand what a stock is doing. So let's just see whether we can set the background here. So we got RSI 50. So that's your RSI. And I'm going to break this down in three portions or three parts. There is what I call uniform activity bounce. So it could be any one of this, any type of uniform activity bounce on RSI 50 tends to be suggesting that there is a turnaround to the upside. And at the same time, that is what I call RSI uniform action support. And we can have the opposite, which is uniform activity support. Here I'm just doing the opposite. All these are rejections as the stock is trying to move above RSI 50. So that's one aspect of using the RSI concept. And just for clarification's sake, I spent a lot of time discussing this in this playlist here. So let's go back to the second way of looking at the RSI 50 level. Let's go back to our clean slate. Again, it's RSI 50. All right. And what we're going to discuss here also is to understand what happens when the RSI jumps above RSI 50. That tends to correspond with a sharp move in price relative to the recent price action. You tend to see a huge reaction higher. So let's say if the stock was trading in a range like this, suddenly it moves back above RSI 50, you get a huge reaction bar relative to the size of the previous moves. And at the same time, when you move below RSI 50, you tend to get the exact opposite. In other words, a stock that was trading in a range, once it moves below RSI 50, you tend to have a huge down session. So whatever time frame, if this is happening on a weekly chart, it's going to be a big down week. If it's happening on a daily chart, big down day. If it's happening on an hourly chart, big down hour. And more often than not, you tend to close at the lows of the range when you're moving below RSI 50, and you tend to close towards the highs of the day when you're moving above RSI 50. And this is critical in understanding what to do. So as an example, if a stock you are watching was trading, let's say, slightly above RSI 50, stock is trading above RSI 50. Now let's put it this way. Stock is trading below RSI 50, let's say at 49, and other things, maybe the monthly chart is showing potential to break out and all that. So this is telling you that be on the lookout for a big up day. And this is information you can use to decide whether to stay in the position and be able to ride that good gain for the day. So you can ride that day to the upside. On the other hand, if you are short, the last thing you want to do is part of a move above RSI 50. If you are just about to get out, you gotta be aware that if you are short an instrument and it is moving above RSI 50, it's gonna be putting pressure on your position. And at the same time, if you are long a position, let's say this is the RSI, it's been trading above RSI 50, you have to be aware, especially if other time frames confirm this, that a move below RSI 50 is going to be putting pressure on your long position. So that's the second way of looking at RSI 50 crossing. There's a third view, and this is a general view. So that's our RSI 50 line, and so 50. Again, that's our RSI, and this one is more general understanding of how stocks behave. And it is a simple way of looking at this, especially on long-term monthly charts. Generally speaking, when your monthly charts and weekly charts and even daily charts, when they are trading above the 50 level, it tends to suggest that prices generally are gonna be stable to bullish. And this is generally speaking. All right. At the same time, the other aspect of RSI 50 is understanding, especially on the big time frames, on the weekly, monthly, dailies, that as long as the more your RSI stays below RSI 50, the more you're gonna be grinding lower. In other words, this sets the stage for the trend. So on the way down, if your RSI stays below RSI 50 for long periods, generally the trend is down. The more your RSI holds above RSI 50 on the bigger time frames, the weeklies, monthlies, dailies, the more your trend is going to be to the upside. So let's take a look at some examples here. In fact, the last two charts that we were discussing on exit signals, we're going to use the same charts because there's a lot of information on all these charts. So let's take a look at those two charts, see what we can understand, how we can use this RSI 50 to determine what to do, what we can do, what to expect. Let's begin with this chart here, and right off the bat, take a look at this uniform action below RSI 50 and back above it. Right, so you went below it and also back above it with uniform action. That was good enough for this reentry, somewhere there. Also, take a look at what happens when you drop below RSI 50. Remember, this is just an example. Drop below RSI 50, big down day. Back above RSI 50, you got right there relatively big up day. Okay, take a look at this down day in relative size to this sideways action. That was a huge day after going sideways in a tight range. That down day corresponds with moving below RSI 50. Hope that is visible. Okay, so we've seen both aspects of crossing and above. You got uniform activity support. Also, now let's take a look at the other aspect, which is since this period here. In fact, we can just put it right there. Generally speaking, during this time period, RSI has been holding above RSI 50, and you can see the trend is obviously to the upside. So here we see a good example of good upward momentum, generally because the RSI on the daily has been staying above RSI 50. Short periods below RSI 50, back above it. Uniform activity below 50, back above it. Also, take a look at another instant here where we have a huge daily drop because the stock closed right there at about 71, and the next day it closed at about 67. Huge drop, and that's a big drop relative to the size of the movement price-wise during this period. So out of nowhere you have a big down day. Why? Because the RSI moved below RSI 50. So you have to understand this, that whenever the RSI moves below 50 or above it, there is a change in the magnitude of the move, and this is based on how you calculate the RSI. And the best way I can explain this, why does the RSI move a lot when it's moving above RSI 50? So that's your RSI 50 line, and why does it move relatively huge magnitude on the way up? Okay, huge magnitude on the way up and relatively big size on the way below 50. And this is simply based on how the RSI formula derives the value for the RSI. And here we have it. So pretty much, let's say the average gain, average loss. So let's say, how can I explain it? Let's say you are trading, you play basketball, you average about 30 points a game. Now, you must be good to average that, but this is for the sake of, you average 30 points over, let's call it a period of 14 years. So you've been doing this for a long time, 30 points. So, all right, it's gonna take something happening like an injury or something of that sort to drop your average from 30, let's say, to 17 points a year. So you've been averaging 14 points, 30 points a year for 14 years, and then on the 15th year you had 17 points, not percent, 17 points. So something must have happened to drop this below your average. Maybe that's not a good example. Let me try again. That wasn't very good. Let's try these simple terms. Your average has been above 50. Let's call it 53% of whatever you are doing over a period of time. So average has been 53. Now, if we are going to introduce, and all this is, let's call it, all these bumps here represent a day, or maybe let's call them weeks. All these are different weeks. So over a period of many weeks, your average is 53. And then on the just one more week later, your average drops to 47. That means that this 1 week event must have been such a huge number to influence the average from staying at average of 53 to an average of 47. At the same time, if your average was 47, so let's change this again. So let's say now week after week your average has been 47 or 48 for many weeks, and suddenly, so your average is 48, and then suddenly you go up just 1 week later, your average jumps to 52. The only way that mathematically this can change is with the introduction of a big number. And it is this introduction of a big number that changes the average RSI score from being above 50, which is above average, to below average. You need a big number for one session, one bar, to change the average from above 50 to below 50. When you're trading below 50, and you've been trading below 50, and suddenly there's something that changes one session, one bar, changes it to above 50, you have to introduce a big number. That big number is what causes the RSI to move above or below 50, and causes the price to move significantly. So back to our example. After spending many days here with the average above 50, one day, it only took 1 day to change the average. 1 day there to change the average from above 50 to below 50. You have to introduce a large number or a large price movement for the RSI to go from being above average to below average. And also we can see the exact opposite. Here you got a strong up day. Why? Because the RSI moves from below average to above average in 1 day. That needs a big number. Hence, you can use that in trading to anticipate the introduction of a large number. And then we get the exact opposite here, moving back below RSI 50 during this big drop. In other words, you went from above average to below average in 1 day, which means you have to introduce a huge number based on the formula. You have to introduce a big number, a big loss, so you can change the average based on how you calculate the RSI. Hope that makes some sense. Now if we take a look at the weekly chart, we can see you went below 50, back above it with V-type formation. That's what I call uniformity support at RSI 50. And it took a while, but subsequently you went back above RSI 50 for this re-entry, which was successful. You got uniform activity below 50, back above it for the lows there, which was this re-entry, which was successful. You successfully bounced at RSI 50, which is successful re-entry. You got double bottom support here and then here. It took a while, but you can see it gives you the lows there and there. We can say those were successful entries. Stock's been up since then. We can also see that uniform activity back above RSI 50. Also, the movement back above RSI 50 led to a big up wick, relatively speaking. Big up wick back above 50 for this up wick, which was of relative size to the upside. So we are seeing all these things we're talking about playing out on this chart. Don't forget that since about 2015, generally speaking, RSI has been holding above RSI 50. And during that period, you can see that the stock's been grinding it to the upside. And that's as a consequence of holding above RSI 50. Take a look at all data monthly. This period here corresponds with holding above RSI 50 from about 1997 to finally breaking below 50 in 2008. And that was good enough to take the stock from $5 over a period of years. It would subsequently grind its way to the upside. Why? Because generally speaking, RSI was holding above RSI 50. You got a drop zone or an area when the stock was down. Here below 50 is when the stock had this down couple of months. You move back above RSI 50, and for the most part you've held above RSI 50 during this period. And again, we can see the trend at the very worst was slightly down, and at the very least, or at the very positive front of the argument, RSI holding above 50 has led to these nice gains. On this example, the last time the stock came to test this RSI 50 level, it held with uniform action, which were the lows of 2014. Stock's been up since then. So we got RSI showing uniform activity support during that period. We can also see there's a lot on this chart, so just taking a look at some of the things that are visible at a glance here, and we can see a break of a trend line here. Also, that corresponded with the move below RSI 50. So from what we are learning here, we can see that the drop took it below RSI 50, which is this big down month right there. There's a big month down in relative size. And in fact, we can zoom in again. So this is all data monthly. We're going to zoom into this drop in late 2007 to show you how it was relatively a big down month. And so let's zoom in here, and you can see this is between this monthly chart from 06 to about 09. We're talking about this drop below RSI 50, which, as you can see in terms of relative size, this movement from here, monthly high, monthly low, was huge relatively to the size of this many months. So for many months, this was the price range, and then suddenly you have this big drop on this month, which is because the RSI moved below RSI 50. Let's take a look at India Glycos Ltd, and here we can see the last time it bounced on RSI 50 was during the lows, where it came and tagged the 50 line, bounced with uniform action for the lows there. And here's a perfect example also of the volatility that takes place. Keep in mind, whenever you find stocks trading around RSI 50, there tends to be an explosion of volatility, generally speaking. For example, take a look at this move here. That move above RSI 50 was big for this up day, and then the next day we had a huge drop, which is this drop here, which corresponds with RSI moving below 50. So by understanding what is going on, you can either relax and just understand the big moves are because of flipping from being above average to being below average, and then again from being below average to being above average. So it's just how the mathematics works. The RSI movement above and below 50 tends to indicate where the average price movement has been, right? And we can use that in understanding what could take place in a market. Oh, and before I forget, one thing we should also not forget here is, let me bring back my clean slate here. One thing I forgot to mention, it's very important to understand this because, all right, so let's say this is our price, our RSI 50 line. This is a biggie, so pay attention. So whenever a stock has come off the highs, it's a price. Prices come off the highs and they pull back. If the RSI has uniform activity of any kind back above 50, keep in mind it tends to suggest that you're going to see an improvement to new highs. Generally speaking, when your RSI has any type of, let's say we make a new high, pull back, RSI comes back, has uniform activity support, this is quadruple bottom support, and moves back again, it tends to suggest that prices are gonna also make fresh highs. So uniform activity support tends to suggest that you're gonna go to fresh highs. At the same time, if we are talking about uniform activity rejection, so let's say this is the opposite, rejection at the uniform activity line, it tends to indicate that prices are gonna be going to fresh lows. So your prices made a low, they recovered, RSI was rejected at RSI 50, means we're gonna get fresh lows. And let's say we get the exact opposite of, in this example, RSI tries to move above 50, rejected, 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 eventually pulls back. So this is a quadruple rejection. That also in our example would indicate that prices are gonna go to fresh lows. So prices are gonna try and recover. RSI is rejected with uniform activity, prices go to fresh lows. So you need to understand this because uniform activity support after pulling back from the highs tends to suggest that you're gonna see an improved move to new highs, while uniform activity rejection tends to indicate you're gonna see fresh lows, and that is, generally speaking, that's a lot of information. We can take a look here at the India Glycos weekly chart. Take a look at this example. RSI 50 support with uniform action. It doesn't get any more clearer. Holds the 50 line, which is the lows here. Guess what? Stock goes on to record fresh highs. So once you see this uniform activity support, based on what we are looking at here and what we are studying, it suggests that the stock would go to fresh highs, which means at this particular point, once it moves back above RSI 50, even in here in the one between the 115 120 price range, you have an idea that the stock might go on to record highs beyond 145 150. That information might have set you up for this gain. Okay, the last time we tried also to move up below RSI 50 here was uniform activity support for the lows here, and you went on to record fresh highs. Even this is uniform activity below 50, back above it. Once you move back above RSI 50, take a look at the re-entry, you go to fresh highs. And at the same time, don't forget, generally what's been happening here, stock's been holding above RSI 50, and stock's been pretty much moving to the upside over a period of many weeks, many months, as you can see. Let's take a look at, go to the all data monthly here, see what we get. Okie dokie. All right, so it's kind of volatile here. All data monthly. Let's zoom in, and we can see here double top rejection while try to move above RSI 50 for the highs here in 14 before this drop. Rejection with uniform activity here for the highs of late 2015 before this drop. Take a look at this expanded volatility area. In other words, the stock was going nowhere for many years as the RSI was playing around with the 50 line, which means a lot of volatility during that period. You got a big up month because RSI moves above 50 for this up month. We move back below 50 for this big down month, relatively speaking. And you can even zoom in here, check for yourself, but you'll notice that there's a lot of volatile action in this box while the RSI was trading above and below 50 repeatedly. All right, let's take a look at the Nifty. We can see here uniform activity support below 50, back above it for this re-entry. In 2012, it bounced perfectly with uniform activity at RSI 50 for the re-entry there. Uniform activity, V-type formation, below 50, back above it. Took many months, but finally that was uniform action for the re-entry here in early 2016. So this principle of what we are learning here is absolutely legit. All right, we can also see here big down month as RSI moves below 50 during this drop, and also recaptures back above RSI 50 for a big up month, which is there. So what we are studying here is absolutely solid and dependable. We can see here holding above RSI 50 for the most part since the lows here. Generally the trend, if you are to make a mistake, was to the upside, while the RSI held above RSI 50, and even right now still continues to hold above RSI 50 after this short uniform activity support, and we are still seeing that it is continuing to gain some good traction. Over the last couple of weeks and months, the Nifty is trying its best to hold back above RSI 50, which might explain why it is beginning to recover. In the same time frame, take a look at the S&P 500. Double bottom uniform activity support for the lows of 2010. Were those the lows? Yes, obviously. So what we are studying here is legit. Uniform activity support for the re-entry there. Recently we've come here, we bounced on the line for the lows there, we bounced on the line again on the 50 line for the lows there. Is the market higher since? Of course. All right, S&P 500 has remained above 50 since about 2010. Take a look at that, corresponds with this generally upward sloping market. So what we are talking about here is absolutely powerful. Take a look at most recent down month here. At some point RSI was below 50. Take a look at how much lower it was. Closed below 50, bounced back above 50 for this big up month because RSI bounced back above RSI 50. Big down month here in 2011 for the lows there. Big down month, big up recovery as the RSI moves above RSI 50 for this bounce month. It's a huge month sometime towards middle to late 2011 as the RSI moved back above RSI 50. Let's take a look at the S&P 500 over the last 2 years. We can see here recently uniform activity bounce above RSI 50, back below it or back above it. Take a look at this huge down week followed by a strong reversal. So let me remove that. You got a big movement in price because RSI jumped below RSI 50. Take a look at this down week. You recover back above it with uniform action. RSI back above 50 for a huge up week. So look, folks, If you understand this, some of these things become very easy to identify. You got uniform activity support at RSI 50 line for the re-entries here. Was that successful? Did the stock go to new highs? Did the market go to new highs? Yes. After this uniform activity support, did the market go to new highs? Of course. On the daily chart, did the market find support recently here towards late 2016 with uniform activity? Yes. Did the market go on to record fresh daily closing highs? Of course, yes. Right? So trust that I've done my research. In fact, let's take a look at the Nifty again, because I know this is what prompted the question. Is we had a huge up week last week as the Nifty moved back above RSI 50. So I was trying to explain why it had a big up week. It's because it moved above RSI 50. I was also trying to explain that if it drops back below RSI 50 this week or whenever it does, expect a big down week. It's as simple as it gets. Above 50, big up week. Below 50, big down week. Want evidence? Big down week here as it moved below 50, big up week the next week as it moves back above RSI 50. Let's take a look at the Japanese market. Big down week in price, moving below 50. Big down week in price, moving below 50. Big up week in price, moving above 50. And this is just a weekly chart. All right. This happens on all time frames. Let's take a look at a different market. Let's take a look at a 2-year weekly chart for the Hong Kong market. Big down week as you move below 50. Big down week in price. Take a look at this range. Price range on this week from here to here. Big down week, right? You recover recently back above 50. Big up week in terms of relative price action. In fact, it is this week right there. Right there. This week. All right. Let's take a look at a long-term monthly chart for the Hong Kong market. See what we got. Bullish period here. Above 50 on a monthly chart. Responsible for this nice movement higher. You have a period below 50 here, which is this down period in price right there. At this period in price, you are down. So you can see that here in about, let's call it from 1990, this period here, we were trending higher over a period of many years, from 1990 all the way to about late 97. Take a look at this uniform activity bounce in 95. I wasn't even trading the market then, but the market was still responding to the technicals. Uniform activity bounce, let me take that off because it's a nice example. 1995, were you trading the market? Probably not. Is this uniform activity below 50 back above it? Sure it was. Was that a major low and a major move to new highs? So I encourage you, let's backtest these charts. All the charts that you study, that you follow, make sense to backtest them. Let's take a look at the Japanese. Let's take a look at the Nikkei, and I want to go take a look at all data going back to 1980. Right, let's go 1980, 0, out 1900, Mr. Muathe. All right, so we go, this is 1980, 2000 and what? 17, January 16th. All right, what do we have here? This was a major bull market phase. Major. The Nikkei moved from under 8,000, under 7,000 to 38,000. Now this is absolutely scary. Now if you think it was easy to make money during this period, think again. It is very hard for somebody to come and buy a market that is up at this point 100%, and then another 100%, and then another 100%. So this was a tough market to be long. I know it seems from hindsight it's an easy market to make money. Think again. It seems easy, but if you are trading in this market, you'd think that the top was just about to happen at any point during this run. Any point, you would have been just getting out of your positions. Why? Because there was nothing, there was no precedent suggesting that this thing would continue spiking. None. So you had no reason to be buying this market during this run-up. Take a look at this lows. 1983, uniform activity below 50, back above it for the re-entry there. And those were the lows before this amazing bull market phase. You find me a market that had that type of a run anywhere, you won't find it. Let's take a look at the RSI 50 as best as we can. Uniform activity rejection there for the highs right here in 1990. Rejection here and here for the highs here and here. Rejection with uniform activity here for the highs there. Even this looks like uniform activity, but not the best, but rejection back below 50 for the lows there. Uniform activity support here and here for the lows here and here. Rejection with uniform activity at RSI 50 for the highs of 2010. Rejection for the highs of 2011. Rejection with uniform activity for the highs of early 2012. You stay back above RSI 50 for this bullish run. Here we have what looks like nice double bottom support with uniform activity during the lows here. Uniform activity took many months, but those were the lows in early 2016, and the market would go on to record a nice bounce and chances of eventually maybe even seeing higher highs. Why? Because we had uniform activity support. Don't believe me, that was uniform activity support. Let's go to the 3-year monthly. Take a look at this. Not the best, but here is uniform activity support. In other words, you go below 50, back above it, that's uniform support. Below 50, back above it, that's uniform support. And that's why you had these lows here and here. And now you're working on attacking these highs. Remember this, what I'm talking about here with RSI 50, is pretty much worldwide. Let's take a look at one more market just to ice this. Take a look at the Brazilian market. Would you call this double bottom uniform activity support at RSI 50 for the lows there? Uniform activity support here for the lows recently. And of course, since it bounced on RSI 50 here, it might be suggesting it's going to attack, either make equal highs or improved highs. Uniform activity double bottom support here. Did the Brazilian market go on to test the highs, if not make new highs? Yes, it did. And even when it was bearish, uniform activity rejection here for the highs there. Uniform activity rejection here for the highs there. So the more you understand this, the more you can add this to your analysis. Remember, this is just one aspect, but if you can add what we're talking about here to other aspects, other time frames, then obviously you're going to end up having a better chance of making good decisions. Let's take a look at the Brazilian market. Here we have all data going back to 1999, above 50. Since from 03 to here in 2008, but still way higher than where it began. Right, so that's RSI 50. You got uniform activity rejection here in 2012 for the highs there. You got uniform activity rejection again 2012, late 2012 for the highs there. You got uniform activity rejection for the highs of 2014, uniform activity rejection here for the highs of 2015. Recently, we've seen uniform activity support in 2016 for the lows there, and market continues to trade higher. Eric Muathe with Muathe.com. As always, good luck, peace, and blessings. And don't forget, you can always get more of this by taking a look at this playlist, all right, which is the RSI 50 level, uniform support or rejection. And also there's another playlist, called RSI 50 crossing. So you got your RSI 50 crossing playlist that you can take a look at if you want more information. RSI 50 level uniform activity support or rejection is the other one. Otherwise, most of what we discussed here is pretty much what you'll find in these videos. Again, one more time, Eric Muathe, Muathe.com. As always, good luck. Let's keep the conversation going. Peace and blessings. I am out. Mwah.